Hi, it's Jeffrey Cohen, Chicago Quantum. We are registered investment advisors in Illinois. I'm an investment advisor representative and the president of U.S. Advanced Computing Infrastructures Incorporated. We're sharing this video to show you how we are starting to build a scalable investment fund based on the Chicago Quantum Net Score. And we're running it during really one of the most tumultuous times in the market, during a bear market, and it's a bear leg down. I'll just share with you what we found. And so we are building the investment fund along the way, and we're going to share it with you. So it all starts off with the model, right? So Jeff, what's the model? So the model is a very elaborate way that we analyze every stock that traded in the markets. It's based on a Chicago Quantum Net Score. A couple things that we noticed along the way. So just trust us. We have to run it every night. It takes hours. It is super painful. The good news is it's powered by Intrinio, which is very, very good professional market data provider. And our Dell server. And we sometimes can run things on D-Wave. They're a quantum annealer if we want a little bit of a second opinion. But for right now, we're just running it on the Dell. And the S&P 500 variance, adjusted closing price variance over the year, is 1.8 times 10 to the negative 4. Now, we look at the stocks, and these are the stocks that pass data validation, and we have tightened up our data validation. It appears we've cut about 100 stocks, or 5%. We really ratcheted up our data validation. We are tightening the screws on quality and liquidity. It's not to say that every stock is an IBM, right, or a Tesla, but at least we're getting rid of some of the real not well traded, right? When you look at stocks that are a little bit more liquid, the all stock variance of 1,977 profitable U.S. listed, U.S. domiciled stocks that traded 5,000 shares a day minimum every single day of the trading, they've closed always above $1. You're at 2.0 times 10 to the negative 4. So 1.8, 2.0, you're looking at roughly the same variance. Now this is equally weighted in our run, and the S&P 500 is market cap weighted, so they get that little advantage by being market cap weighted. It's actually it's a way to reduce volatility in your investments. We could introduce that into our Chicago Quantum Net Score Fund. And in fact, we might try that next week. Do some homework on the weekend. So very interesting now, right? Because that's a good question. So if you market capitalize the investment fund, you do reduce volatility without necessarily reducing expected returns. We'll take a look. Maybe we'll do side by side, right? That's cool. We learn a lot, right? So now we run it, and what's interesting is we had to change some things. We changed some things. Now this is totally inside baseball, so get your video cameras out. Oh wait, we made a video. So you don't have to record it. You just have to pay attention. So what we changed last night is we changed our risk-free rate of return from 2.3 to 3%. We did that because 1 month treasuries are starting to trade close to 3%, and you can just go to treasury.gov, buy all the treasuries you want. You know, expected return. We are in a bear leg. It's obvious. I'm looking at my stocks and I'm looking at portfolios and I'm just looking at a lot of drops. So we lowered the expected return floor, that's capital gains versus plus dividends, to 7% from 7.5%. Not a big change. Not a we're going crazy. We're turning into communists. No. It's a 0.5 point. Expected return lowered by 0.5 point. Floor, that means if the exchanges are not already delivering, 7.5%, we pick them up. And the risk-free rate of return has been increased from 2.5% to 3%. That completely changed the analysis. Gone are certain stocks, reintroduced, new introductions to a lot of stocks that you know that you love. These are stocks that you know and that you love. Actually, you may not love them, but you know them, and they're like big stocks. Minimum closing price for the year is $1. Minimum volume of stocks traded daily for the past year is from 1,000 to 5,000. And here's the thing: if we're going to be trading in and out of stocks on a daily, weekly, monthly, yearly basis, I can't have to wait. I can't have stocks that trade, 1,200 shares a day, and maybe I've got 5,000 shares or 10,000 shares I want to unload. What, I got to wait a week? That kind of trading lack of liquidity really could mess with our model. So, and we could raise that more. We didn't lose a lot of stocks. We lost 5% of our stocks by just trading the minimum volume and the minimum price. Now, why are we changing the price? $1 stock is what it takes to stay listed. So stocks that are trading below $1 potentially might not be there tomorrow. Okay, so best stocks today. We ran our model, and our edge, this is so fascinating. The edge of our run is down by 10 times, 8 times, 9 times. It used to be 00052, and now it's 4061. So we're going to call that, it's a 90% reduction in edge. Just something simple, like expected return changes and risk-free rate changes, and your edge is gone almost. But there's still an edge, and we're going to trade it. Okay? So, had a whole bunch of questions, but let me show you the net of what happened. So, we changed some of the underlying assumptions of the model, and how do I show this to you without... Let's just try this. You tell me if you can't see the important stuff. Coin, SI, SITM, LC, and Etsy and apps all had to be sold. Those stocks were not attractive in this new world of higher expected return, lower expected returns, and higher risk-free rate. So we sold them. We sold them actually at, where does it say? It was like 10:02. It was like 10 o'clock. So proceeds at 10 o'clock ET. So market open 30 minutes. And the reason that we did it then is just because in the real world, we got our kid off to school, read a few tweets, we researched our own personal stocks, because we're paper trading it, right? We let ourselves get distracted. Plus, the market was going up this morning. And so I thought that if we let the system, let the gains bake in a little. I mean, the S&P 500 is up 1% already this morning. Let's take that 1% in our stocks, right? Now that bias, I probably got to get out. I probably got to make all the trades in the first 3 minutes of the day, or maybe even pre-market. But for right now, I don't know. Pre-market I don't like, because pre-market has the spreads, right? So these were so we had to sell 6 stocks. Most of them were sold at a loss from where we bought them. Now that's because the S&P 500 has been dropping. But it's interesting that when your expectation is to make less money, the new stocks that we had to add and stocks that we got to keep these two. Oh, and DDS we sold yesterday. We had to rebuy it. So there's a lot of churn in this. But these are stocks we get to keep. Not here. Not here. Do I have a place to make notes? Yeah, hold. So we're holding those. We're trying our best to keep track of all these numbers, man. It's crazy, all right? We're probably going to have to build a model that's more automated. But for right now, everything's spreadsheet and everything is being adjusted. So Apple. I'm going to pop these up in a different... First, let me just show you. Here are the stocks we had to add. We add enough stock so that all of the NAVs, all of the values are about the same, and it's based on the most expensive stock. So the most expensive stock is $854.20. So every other stock should be trading around $854.20 worth. You see some of them are at 906, one's at 818, so they're all kind of in the ballpark, right? 906, oh, and then one is 957. So 957 to like 818. Close enough. So you buy all those, 23 of them, it's $20,000. But you got to hedge, because this is not a model that just says make money when the market goes up and then lose your ass when the market goes down. This model says I'm going to make more than the S&P 500. So an even hedge is 50 shares of the SPY ETF. We're not big enough right now to start trading futures, and I don't believe that the firm that manages our trades would allow us to trade futures. However, we have a stack of paperwork for a custodial firm that when we're ready to go public and manage a fund, they are ready to provide us with advanced custodial services, which is terrific, by the way. So 50 of them. Now, if we want to hedge at what I'll guess is roughly a 2 times beta. Now, I'm going to have to update our model to give us the beta values for every stock. It's fine. I can do that. That's not hard. Pop it out in a spreadsheet, be like, yeah, there's my betas, add them up, whatever. But for right now, if we approximate a 2 times beta, that means we have to be short 100 shares of the SPY ETF, which would be now long 20,000, short 19,923 is model 1, and a beta hedge model is your long 20,000, your short 39,846. It's just what it is. So this, and just to document that it is in fact short. So the challenge of this is always, I'm one guy, right? I don't have a firm. I have a home office, right? And I got a mouse and I got a keyboard. And I got a really crappy company that I use to trade my own stocks, which is more of a firm that you use when you want to protect yourself from doing something stupid. They say no more than they say yes. So I went ahead with my starting price buys, and I just I used the last trade price at the time I looked. So assuming that I can just buy at market, buy at the last price. A lot of these aren't moving that much, minute to minute, second to second. So these prices may not be perfect, but I don't know if I could make more money by using limit orders. I figure 6 shares, just throw it in a market, wrap it up, right? I'm going to get what I get. So here are the prices that were paid. Right? I bought them all at 9:55 Eastern Standard Time, and those are all my buy orders. And then I got my sell shorts. Now the good news is from yesterday we were already holding 15 shares short. So all we had to do was buy short another 35 shares. And what I'll say is buy short another 85 more shares. All right, so it changed a lot, right? And we're going to talk about this a little bit. It changed a lot. And actually, by running what I'll call a lower risk version of the Chicago Quantum Net Score with 1/9 the edge, you have to invest more money. Before we were investing like $4,000. Now you got to invest $20,000 long and 20 or 40,000 short. So the minimum just got bigger, but we're up to 23 stocks. So let's take a look at some of these stocks because I've been tracking a bunch of these stocks and they are just super interesting. Okay, so let's see if I can get one with the name. By the way, this is not what we hold, so this is not our stuff. So let's take a look at the stocks that we sold. Etsy, which is pretty edgy, e-commerce. Lending Club Corporation, which sells mortgages. Wow, that's risky right now. Digital Turbine. Coinbase. Silvergate. So Coinbase is like a Bitcoin trading platform. And my coffee's so old. The pot turned off. All right, I need coffee. Silvergate is a lender to Bitcoin miners. That's crazy. SI Time makes little chips that tell time. It's not a very valuable company. It's an interesting company. So that's what we sold. What we bought, XPO Logistics. Now, I don't know that firm. VMware, I know. VMware is a software company, B2B, about as conservative as you can get. Tesla, State Street, the RMR Corp, I don't know. Rocket Companies is another mortgage company. So I don't know why the model likes mortgage companies. I would think they're all going to zero, but maybe not. B. Riley Financial. Oh, yeah. Here we are recommending B. Riley. I would expect B. Riley to be recommending Chicago Quantum as a low-risk, high-return, great stock for you. We're not traded yet. P. Zena Investment Management. My guess is that is a business development corp, and we will be taking it out of our model, but it showed up, right? We pull out business development corps, foreign companies, SPACs that are not a company, and so that might have fallen through the cracks. Don't know. We'll check. NVIDIA, Mercado Libre. So you know NVIDIA, right? The chips guys. Mercado Libre is e-commerce. Cool. The Masaryk company, I don't know. Intuitive Surgical, I don't know. Look at those market caps, though. Masaryk is 2. Intuitive Surgical is a $74.5 billion market cap. These are big companies at once. Intuit, Fortinet, European Wax Center. Who doesn't love a nice European wax job, right? Let's take a look. Oh, see? I waxed that baby. No, I don't know about that. But I love showing off my arms. That's nice. I have no idea what European Wax does. I don't know if it's wax, like wax jobs with hair, or if it's waxing your car. Don't know. Diana Shipping. Now that's interesting. $415 million. My wife's named Diana. Maybe we hang on to that one. Dillard's Department Store. Closely held stock. I want to say it's the family owns most of it. Carlyle Group. Now that's so interesting because they do really well in our model, and the Blackstone Group love these two companies. I love them personally. I think it's great that they showed up. These are money managers that are the smartest guys in the room. Why wouldn't you want to buy a company that's full of the smartest guys in the room? And women. Men and women, I mean guys. Amazon. Advanced Micro Devices, American Financial Group, and Apple. Come on now. Now, if we were to market cap weight these, just to put it in perspective, Apple is $2.5 trillion, and Diana Shipping is $415 million. So does that say that we have to hold that much Apple relative to that much of these others? It might. And so we're going to have to build two models tomorrow to see what that looks like. Actually, Monday. Because it's interesting to me. Our model has always been even weighted, right? And it runs even weighted. So we're going to stay even weighted, but it's interesting to look at. Maybe that's something to look at. So again, it's a big spread in market caps. Big spread. Couple billion, tens of billions, hundreds of billions, and then two stocks that are in the trillions. And so, what? As a reminder, right? What is the Chicago Quantum Net Score? Jeffrey, what is it? Why do I want it? This is stupid. I don't know what this is, and now you're building a whole fund around it. Well, let me tell you what the Chicago Quantum Net Score is. It's a stock portfolio optimization model These are the details we have on our website, so it better be true, right? They are expected to outperform the equity market by having lower historical price volatility and higher expected returns than any other stocks, individual stocks, or portfolios. Now, we have to add back dividends because, you know, when you pay out a dividend, it makes your stock go down on an adjusted basis. If I pay $1 dividend, the next morning it opens up $1 cheaper. So we add back the dollar. Okay. So I don't punish dividend stocks. We look at 11,000 roughly stocks that traded like last night, like tonight, right? We do our run. And you get an evenly weighted portfolio and they're all profitable stocks. There's all this other stuff too. Now, I don't talk about what the Chicago Quantum Net Score is in this page. So let's see if it's in the main page. So these portfolios have less price volatility and more expected return than other portfolios. So lower volatility, higher return, held together evenly. So there's zig and there's zag in there that help it to balance out. And here's an article in Medium that shows you how it works. It's the best risk-return trade-off that day based on a prior year of trading. And if you want to know what the Chicago Quantum Net Score really is, you search it on Archive. Chicago Quantum and Portfolio Optimization. So let's try that. There it is. Portfolio optimization of 40 stocks. Portfolio optimization of 3,171 stocks. On and on and on. So, we have a vanity page. Oh my God, we have a vanity page. This is beautiful. I didn't even know we had this. Oh, I love it. Oh, that's awesome. That's really pretty. All right, we're going to have to throw that link on our website. But that's, oh, that's so pretty. All right, so let's take a look. So here's the math. Here's the validity of the formulation. Here's classically how we can look at it. The optimal portfolio. We try our best to transform. And the results. And there's D-Wave. Weighting assets. Selecting economic values. Discussion of quantum advantage. All right. So, this is cool. You have to really understand some math to be able to understand what we're doing. So what I would say is this. If you believe that a set of stock prices I'm looking for where it is. Here it is. If you just believe that a stock or a set of stocks with the lowest amount of risk as measured by price, closing price, adjusted closing price volatility or variance for the whole portfolio, and you compare that against the expected return of those portfolios using a very classical method using beta and market returns of risk assets. And then you find the portfolio with the minimum risk versus so it's the minimum net, Chicago Quantum net score. It's the risk versus return. And if you look at that, you would think, oh, people love a portfolio that doesn't have a lot of risk, but is expected to go up in price. I don't want to be sweating. Personally, the more risk that I take, the less I sleep at night and the more jogging I have to do to be able to be coherent. I mean, I don't like riskiness. I act like a widow and an orphan here. I got a certain amount of money and I want to protect it. I want to make a profit, but I don't want to lose. And so you're probably like that too. You don't want to lose money. You want everything nice and stable. Just a profit every day. Oh, look, every day I made 1%. At the end of the year, I made 253%. Never had a loss. Love it. By the way, it could be a 1/10 of 1% every day, and I make 25.3% every year. I'm loving life, right? But when it goes up and down a lot, it's very stressful. And so this model should go up and down least, given that it also has a very high return. Now, when we adjust things, where's that adjustment? We're tracking a lot of stuff here. It's painful. When we adjust things like risk-free rates of return from 2.5% to 3%, and expected return floor from 7.5% down to 7%, those two changes are enough to go from 5 stocks that are on the edge of e-commerce and crypto and just nails on a chalkboard for risk to, you know what, I'll take some of that risk, Dillard's and NVIDIA and Melly, but I want some less risk. I want some B. Riley and Carlyle Group and Blackstone and, deal me out some of that AMD and some Amazon and some Tesla. I mean, I love a little risk, but Tesla's not going anywhere. And I'll take some Amazon. Oh, I'll take some Apple too. There's a real high flyer, right? And so the point is, I'm mixing in some B2B. I've got some B2C. I got State Street. I mean, I got some solid names, right? And those are going to anchor the portfolio, all because of 2 half-a-point changes in our assumptions. No, I will say this. When I run the model over the weekend, I need a bigger edge. That edge, that 0.00061, by the way, 0 is no edge. I'm going to compare that. Where were we yesterday? Did I add what the edge was? Let's take a look. No. Maybe. Nope, I'd have to look. But it's funny. The first day in the model, Coinbase, Melly, NVIDIA, which you know, Silvergate, SI Time, Digital Turbine, and Dillard's Department Store. And now we've got 23 stocks. Logistics firms, VMware, B2B, Rocket Mortgage, and only one that may be an anomalous stock that we have to pull out for Monday. We'll just pull it out of the whole analysis. Not just out of the answer, but the whole analysis. So, all right, I want to thank you for watching. If you're interested in learning more about our firm, if you're interested in potentially becoming a customer, if you're interested in any of those things, I'd like to ask you to please go to our website, which is chicagoquantum.com. We're not allowed to sell without showing you a brochure. The brochure includes all of the costs, all the terms and conditions of working with us. And to be honest, we're very flexible, but you should know. I got a brochure summary, a threefold. I've got a detailed brochure. Until the brochure says that we're offering money management services, we're still non-discretionary. And what you're buying from us then is you're buying the up run, you're buying the down run, or you're buying some custom app development, right? You could buy some investment planning, but you're not buying into a fund. We don't offer that yet. But when we do, we'll update our brochure. You can check it out. You can also, you found us on YouTube. You can always go to our YouTube channel. We have some other spots here. Archive. Our archive research is here. Our Medium articles, we don't really publish anymore in Medium, but we keep all our articles out there. And we have a presence on Twitter. I apologize if you're politically sensitive. Some of our tweets can be quite assertive. And so, but in general, we use Twitter to publish our blogs and our videos. And, you know, sometimes we talk about things. Like, here's an example, just to close out, because I want you to go check out our Twitter page, which is Chicago Quantum. So this is true. So Bank of America is now offering 0 down payment, 0 closing cost loans for Black and Hispanic first-time homebuyers. And the comment made by Jared Dillian, who I agree with, and so I retweeted it, the irony here is if you give someone 100% financing on a house, so loan to value is 100%, and by the way, you don't know if the appraisal's good, so in fact it could be loan to value of 110 or 120% if the appraisal's a little high. You're not doing them any favors, as we learned 14 years ago. And I agree with that. If you don't have enough money to put down for a home, then you definitely don't have enough money when things break. And so in our case, I had a year when the air conditioning had to be replaced. The garage door had to be replaced, and other things. We've had to spend as much as $10,000 or $15,000 in a year to keep up our home. So you have to have that. If you don't have any money to put for down payment, you may not have money to put in for repairs and maintenance. And so then your house becomes a little bit unlivable. Again, thanks for watching. Hit the subscribe button. It's a red button. It helps let YouTube know that we're trusted and that they can recommend, you know, on the right, it recommends the videos. And check out the website. If you want to drop a comment, that's great. And if you want to contact us, hit the contact tab. Here's our CRD numbers and cell phone number, address, email address. And you can do the FINRA broker check as well right here. Go to broker check. You type our name or our number. You can do the same thing for our firm. And wrap it up. See if it shortened their name. Oh boy, we'll do individual. 744-1300. It's so interesting. Just trying to look myself up. There we are. And there's U.S. Advanced Computing Infrastructure, Inc. You need the whole thing. All right. Check out the SEC website. There we are. State licensed. Wrap it up. So, thank you very much for watching. We are registered advisors in Illinois, and we wish you good luck in the markets today. Bye-bye now.